The Little Book of Value Investing by Christopher H. Browne. Picture yourself wandering through the supermarket, pushing your cart down the aisles, completely lost in thought about what's for dinner this week. You round the corner into the meat section, and suddenly something catches your eye under those harsh fluorescent lights. Your absolute favorite steak, prime Delmonico, is sitting there with a massive discount sticker slapped on it. We're talking about a cut that normally runs $12, maybe $13 a pound, now marked down to just $2.50. So what do? Well, if you're like most people, you practically sprint to that display and load up your cart. You're already mentally calculating how much will fit in your freezer, because you know a screaming deal when you see one. Next week that price tag will be right back to normal, and you'll be kicking yourself for not grabbing more. This is just basic common sense, right? It's exactly how we approach shopping for everything in our lives, whether we're hunting for clothes, cars, or the latest gadgets. We're hardwired to hunt for value. We wait for the sales. We get excited when prices drop. But here's where things get weird. When it comes to the stock market, we throw all that common sense right out the window. In the stock market, it's like we become different people entirely. When prices are shooting through the roof, when everyone and their grandmother is talking about some hot stock, we can't hit that buy button fast enough. We're terrified of being left behind. And then, when prices tumble and fear spreads through the market like wildfire, we panic and sell everything, desperate to protect whatever we have left. We actually buy high and sell low. It's this bizarre pattern that's been playing out since markets existed, and honestly, it's the main reason most people never build the kind of lasting wealth they dream about. But what if I told you there's another way? What if you could take that same simple grocery store logic and apply it to your investments? What if you could learn a timeless approach that has quietly made fortunes for some of history's smartest investors, including legends like Warren Buffett and his mentor, Benjamin Graham? That's exactly what we're exploring today with The Little Book of Value Investing by Christopher H. Browne. Now, Browne wasn't just some guy who wrote a book about investing. He was a genuine legend in the industry, the managing director of Tweedy, Browne Company, which happens to be the oldest value investing firm on Wall Street. And we're not talking about just any firm here. This was the place where Benjamin Graham himself did his business. This was the firm that helped Warren Buffett buy most of his Berkshire Hathaway stock, the foundation of everything that made him one of the richest people on the planet. Christopher Browne didn't just study this philosophy from textbooks. He lived and breathed it. He grew up right at the beating heart of value investing, learning directly from the masters themselves. And in this compact but incredibly powerful book, he basically pulls back the curtain and shares those hard-won secrets with the rest of us. So for the next little while, I want you to forget everything you think you know about the stock market. Forget those flashing ticker symbols, the loud personalities on financial TV, and those intimidating charts covered in lines. Today we're stripping everything back to basics. I'm going to walk you through a philosophy that's so straightforward, so logical, and so remarkably powerful that it has consistently beaten the market for more than 70 years. By the time we're done, you won't just understand investing better. You'll have a timeless framework for building real wealth, one that replaces fear with confidence and turns gambling into calculated strategy. Our journey doesn't start with a hot stock tip, but with something much more profound. Buy stocks the same way you buy everything else when they're on sale. Christopher Browne hammers home that this single shift in thinking is the foundation of all investment success. Most people get completely swept up in the excitement of trendy stocks, the ones dominating headlines and dinner conversations. They chase momentum, buying whatever's going up, secretly hoping it'll keep climbing forever. But here's the thing, nothing goes up forever. Eventually, growth slows down, the excitement fizzles out, and the people who bought at the peak are left holding the bag, with some pretty painful losses. A value investor takes the complete opposite approach. They're like that patient shopper who methodically walks through the aisles of the stock market, scanning for high-quality companies that, for whatever temporary reason, have been marked down. They get that the price tag on a stock and the actual value of the underlying business are two completely different animals. And the real magic, the opportunity for incredible returns, lives in that gap between the two. Now, Browne didn't invent this idea out of thin air. It was pioneered way back in the 1930s by this brilliant professor and investor named Benjamin Graham. Graham literally wrote the Bible of investing, a book called Security Analysis, and he spent years teaching these principles to students at Columbia Business School. His most famous student? A young guy from Omaha named Warren Buffett. And here's where Browne's personal story gets really fascinating. His father, Howard Browne, co-founded the firm Tweedy, Browne & Riley back in 1945. They carved out this peculiar little niche for themselves, finding buyers and sellers for stocks in small, obscure companies that weren't even traded on the major exchanges. Their clients were, by definition, people who cared about the deep underlying value of a business, not its daily price bouncing around. Their office was at 52 Wall Street, literally just down the hall from Benjamin Graham himself. They became Graham's go-to broker, helping him hunt down those deeply undervalued cigar-butt stocks he was famous for finding. Walter Schloss, another of Graham's disciples who managed to compound money at nearly 20% for almost 50 years, even had a desk sitting in their hallway. Then, in the 1950s, a young Warren Buffett showed up, armed with Graham's principles and hunting for bargains. One company he discovered was this struggling textile manufacturer called Berkshire Hathaway. The stock was dirt cheap. And guess who Buffett called to buy those shares? Howard Browne. It was literally Browne's firm that executed the trades, giving Buffett control of the company that would eventually become the foundation of his entire empire. Christopher Browne grew up breathing this rarefied air. He started working at the firm in 1969 and never left. He wasn't just taught these principles in some classroom. He watched them work in real time, day in and day out, through some of the most turbulent decades in market history. He saw firsthand that value investing wasn't some abstract theory. It was a battle-tested machine for creating wealth. So what are the core principles that make this machine run? Browne distills it down to two beautifully simple concepts. The first one is intrinsic value. This answers the fundamental question, what's this thing really worth? Forget about the stock price dancing around for a second. If you were going to buy the entire company, the factories, the brand name, the cash sitting in the bank, what would a knowledgeable business person actually be willing to pay for it? That's its intrinsic value. A value investor basically acts like a real estate appraiser, except they're appraising businesses. They roll up their sleeves and do the homework to figure out that number. Why does this matter so much? Because it gives you a North Star to navigate by. It tells you whether a stock is an absolute bargain or if it's dangerously overpriced. Browne gives this powerful example of Microsoft back in 1999. It was an absolutely fantastic company with incredible growth, but its stock was trading at 84 times its earnings. The price had completely detached from reality, from its intrinsic value. And what happened next? Even though Microsoft's business kept growing beautifully, the stock price got cut in half over the following 6 years. People who bought at the peak owned a genuinely great company, but they paid a terrible price for it. They actually lost money on a winner. Think of intrinsic value as this gravitational pull on the stock price. A stock can float above or sink below its intrinsic value for a while, pushed around by market emotions and hype, but eventually, and history proves this again and again, the price gravitates back toward the value. This brings us to the second and arguably most critical principle, margin of safety. This is Benjamin Graham's most famous concept, and it's the key to Browne's first rule of investing: don't lose money. The second rule: don't forget rule number 1. A margin of safety is simply the discount between what you pay for a stock and its intrinsic value. Graham wanted to buy stocks for 2/3 of their intrinsic value, or even less. He wanted to buy $1 of assets for 66 cents. But why? For two huge reasons. First, it creates enormous potential for upside. If you buy a stock worth $10 for just $6.50, it can rocket up more than 50% and still not be overvalued. Second, And this is even more important. It gives you a cushion if things go sideways. Maybe you miscalculated the intrinsic value a bit. Maybe the company hits an unexpected rough patch. That margin of safety acts like a shock absorber, protecting your capital from permanent loss. Browne calls it having belts and suspenders for your stocks. It's the ultimate defense mechanism. Think about the alternative for a second. If you buy some hot, overpriced stock and it crashes hard, history shows it might never climb back to its former glory. That's what Browne calls, quote, permanent capital loss. But if you buy a solid, maybe even boring company at a deep discount, and its stock price falls during some market panic, you have this quiet confidence, knowing you own something fundamentally worth more than what you paid. In time, the price is likely to bounce back. This principle is what allows a value investor to stay completely calm and even get a little excited when everyone else is losing their minds. So the philosophy is elegantly simple. Figure out what a business is actually worth, then try to buy it for significantly less. But how do we actually find these bargains in the real world? Browne gives us a treasure map with several key markers to look for. The first and most common marker is a low price-to-earnings ratio, or PE ratio. This is just the company's stock price divided by its annual profit per share. It tells you how many dollars you're paying for $1 of the company's earnings. A stock with a PE of 10 means you're shelling out $10 for every dollar of profit. A stock with a PE of 40 means you're paying $40. The lower the PE, the cheaper the stock is relative to its earning power. Browne likes to flip this around and think of it as an earnings yield. A stock with a PE of 10 has an earnings yield of 10%, 1 divided by 10. A stock with a PE of 20 has an earnings yield of 5%. Then he asks this beautifully simple question. Would you rather own a business with a 10% earnings yield or a 10-year Treasury bond yielding 5%? The business is obviously a better deal, and unlike that bond, its earnings have the potential to grow over time, which protects you from inflation, that silent wealth killer. Decades of academic studies, which Browne meticulously details in the back of his book, have confirmed this pattern over and over. Across almost any long-term period you measure, a portfolio of low PE stocks has dramatically crushed a portfolio of high PE glamour stocks. This pattern shows up across different industries and in different countries. It's genuinely one of the most reliable and persistent truths in finance. Buying earnings on the cheap just works. The second marker on our treasure map is a low price-to-book value ratio. Book value is simply a company's net worth. Everything it owns, like cash, buildings, and inventory, minus everything it owes. It's basically the accounting value of the business. When a stock trades below its book value, you're theoretically buying those assets for less than they're worth. You're buying $1 for, say, 80 cents or 60 cents, or sometimes even less. This was actually the original specialty of Tweedy Browne. They hunted for obscure, forgotten companies trading at deep discounts to their asset value. It's an incredibly powerful margin of safety. In a worst-case scenario, if the company had to be liquidated and everything sold off, those assets alone could be worth more than what you paid for the stock. Browne shares these incredible stories of finding companies, even in relatively recent years, trading for less than the cash they literally had sitting in the bank. When you stumble across a situation like that, you're essentially getting the entire operating business thrown in for free. Just like with low PE stocks, study after study has proven that portfolios of low price-to-book stocks have delivered superior returns over the long haul. It's another powerful, reliable indicator that you might be looking at real value. Now, having these tools is one thing, but where exactly should we be looking? Browne was actually one of the early champions of global investing, and his logic is, once again, pure common sense. He asks, why would you limit your grocery shopping to only half the store? The United States, while it's a massive market, represents only about half of the world's publicly traded companies. By expanding your search to other developed, stable countries throughout Europe and Asia, you literally double your odds of finding a fantastic bargain. You might be surprised to learn that of the world's top 20 corporations by sales, more than half have their headquarters outside the United States. Think about companies like Nestle, Toyota, Samsung, or Shell. To just ignore them is to ignore some of the world's absolute finest businesses. Browne discovered that sometimes entire markets go on sale. Back in the early 1980s, his firm noticed that Japanese insurance companies were trading at what appeared to be their book value. But after digging a little deeper, they uncovered this quirk in Japanese accounting. The companies were carrying their massive stock portfolios at their original purchase cost, not their current, much higher market value. After a huge run-up in the Japanese market, the real book value was actually 3 times what was being reported on paper. These companies were selling for 1/3 of their true worth. Browne's firm loaded up on shares, and just 6 months later, regulators changed the reporting rules. The stocks absolutely soared. It was a classic value investing treasure hunt. He does caution, though, to stick with stable, developed countries that have predictable rule of law. He calls the so-called emerging markets a dangerous game, prone to these wild boom and bust cycles that can lead to staggering losses. His focus stays on places like Western Europe, Japan, Canada, and Australia, where the basic principles of business are fundamentally the same, even if the accounting might look a bit different. So we've got our philosophy, and we've got our markers for finding value. Browne adds one more powerful tool to our kit. Watch the guys who really know what's going on. By this, he means corporate insiders, the CEOs, CFOs, and board members who actually run the company day to day. These people have intimate, detailed knowledge of the business. When they reach into their own personal bank accounts and start buying their company's stock on the open market, it's one of the most powerful buy signals you can possibly get. There are plenty of reasons an insider might sell their stock. Maybe they need money for a house, their kids, college tuition, or just to diversify their personal wealth. But there's really only one reason they buy with their own money. They genuinely think the price is heading higher. In the U.S., insiders have to publicly report their trades within 2 business days. This transparency allows you to essentially invest right alongside the people who know the company better than anyone else on the planet. And again, the research is crystal clear. Stocks with heavy insider buying have historically crushed the broader market. It becomes even more powerful when you find a stock that's already cheap based on PE or book value and has insiders actively buying. That's basically a screaming signal that something good might be brewing. The same logic applies when a company announces a share buyback program. When a board of directors decides that the absolute best use of the company's cash is to buy back its own stock, that's a profound statement. They're essentially saying they believe their shares are undervalued and represent a better investment than any other project or initiative they could possibly fund. Armed with these principles, the value investor now has a framework for navigating the most difficult part of the market, the emotional roller coaster. Browne talks about things that go bump in the market: dramatic crashes, economic fears, industry-wide panics. These are the moments when most investors get completely overwhelmed by fear. Their primitive fight-or-flight instinct kicks into overdrive, and they flee for the exits. The value investor, firmly grounded in the principles of intrinsic value and margin of safety, sees these moments not as a threat to run from, but as a golden opportunity. A market crash is simply a store-wide clearance sale. It's Black Friday for stocks. Browne reminds us what Warren Buffett said during the brutal bear market of 1974, when stocks had been absolutely crushed. He told a Forbes reporter that he felt like an oversexed guy in a harem. He was practically giddy, because everywhere he looked, he saw incredible bargains just sitting there waiting to be scooped up. This contrarian mindset is probably the hardest part of value investing to actually pull off. It requires the temperament to swim against the current, to buy when everyone around you is selling in panic, and to sell when everyone else is euphoric and convinced prices can only go higher. So how do you actually put all this together into a workable process? Browne lays out a clear roadmap. You start by screening the entire universe of stocks for your value characteristics. low PE, low price to book, and so on. Today, with free tools like Yahoo Finance, you can do this with just a few clicks. This gives you a list of potential candidates worth investigating further. But this is just your starting point. Many stocks are cheap for a perfectly good reason. They have fundamental problems that might be terminal. Browne calls this process sifting out the fool's gold. You absolutely have to avoid companies drowning in debt, those facing technological obsolescence like the last buggy whip manufacturer desperately clinging to life, or those stuck in industries with cutthroat competition where nobody can make decent profits. Once you've got a promising candidate, you need to give the company what Browne calls a physical. You need to dig into its financial statements and really understand what's going on. Look at the balance sheet to make sure the company is financially strong, with more assets than liabilities, and a healthy cushion of cash. Then examine the income statement to understand its profitability. Are sales actually growing? Are profit margins holding steady? Does it generate a good return on the capital it employs? You don't need an accounting degree, but you do need to be able to read these vital signs. Finally, Browne gives us this checklist of qualitative questions to ask ourselves. Can the company raise prices without losing customers? Can it control its costs effectively? What are its main competitors up to? What would this entire business be worth if it were sold tomorrow to a knowledgeable buyer? Working through these questions gives you a deep, holistic understanding of whether you're looking at a real business or just cheap for a reason. Now, after all this careful work, let's say you find a genuinely great company selling for 50% of what you believe it's actually worth. You buy it. And then comes what might be the hardest part of all: patience. Browne is absolutely emphatic that value investing is a marathon, not a sprint. You have zero idea when the market will finally wake up and recognize the value sitting in your stock. It could be next week, next year, or even 5 years down the road. Most people desperately crave immediate gratification. They buy a stock and expect it to shoot up right away. If it doesn't, they get impatient and frustrated, often selling right before it finally makes its big move. A value investor is more like a farmer than a day trader. They carefully select their seeds, plant them in fertile ground, water them, and then they wait. They don't dig up those seeds every single day to check if they're growing yet. They trust the process, knowing that when the season is right, the harvest will come. This brings us to what Browne sees as the great paradox of value investing. If it's this simple, this logical, and has such a powerful track record of success spanning decades, why do so few people, maybe only 5 to 10% of professional money managers by some estimates, actually practice it? Browne's answer cuts deep. He says it's not really about intelligence or analytical ability, it's about temperament. The money management industry is completely dominated by herd instinct. It's much safer for a manager's career to be wrong when everyone else is wrong too, than to be wrong all by yourself. Being a contrarian is lonely and professionally risky. Value investing also requires you to buy stocks that are currently out of favor, the ones with obvious warts and problems. It's not particularly exciting to talk about at cocktail parties. You feel kind of foolish admitting you bought some boring ice cream company when everyone else is bragging about their hot tech stock that just doubled last month. And finally, most investors are dangerously overconfident. They genuinely believe they can time the market perfectly, jumping in and out to catch all the big moves while avoiding the drops. But Browne presents overwhelming evidence that market timing is essentially a fool's game. The vast majority of the stock market's long-term returns actually come from just a tiny handful of explosive days. If you happen to be sitting on the sidelines in cash during those specific days, your returns get absolutely crippled. He cites this study showing that from 1990 to 2005, if you'd invested $10,000 and just stayed put, it would have grown to over $51,000. But if you'd somehow missed just the 30 best trading days during that entire 15-year stretch, your investment would be worth less than $16,000. The real secret, he concludes, isn't market timing at all. It's time in the market, invested in a carefully constructed, diversified portfolio of undervalued businesses. The core principles haven't changed one bit since Benjamin Graham first laid them out nearly a century ago. The specific tools we use to find value have evolved with technology, sure, but the fundamental idea, buying $1 for 66 cents and then patiently waiting for the market to wake up, remains the most reliable path to building wealth ever devised. As we take a step back and absorb the wisdom packed into Christopher Browne's little book, what really strikes me is its profound simplicity combined with this deep sense of calm it radiates. In a world that constantly screams at us to act now, to chase whatever's trending, to never stop moving, Browne offers something radically different, a philosophy rooted in patience, discipline, and good old-fashioned common sense. He completely demystifies Wall Street, stripping away all its complexity and intimidating jargon, revealing it for what it really is, a giant marketplace, full of human emotions running wild, where incredible bargains can be found if you just know how to look and have the courage to act. The most powerful lesson for me personally is this idea that the greatest enemy to our financial success isn't a bad economy, a recession, or even a market crash. It's ourselves. It's our own psychology, our fear when things look scary, our greed when things look exciting, our impatience when nothing seems to be happening, and our deep-seated desire to follow the crowd because it feels safer. Value investing is as much a psychological discipline as it is a financial one. It provides this logical framework that acts like an anchor in a sea of swirling emotion. It gives you the actual courage to be greedy when others are fearful, not because you're gambling, but because you're acting on a careful, calculated assessment of real value. For someone just starting their journey, maybe a 17-year-old standing on the cusp of adulthood and facing decades of financial decisions ahead, this philosophy is way more than just an investment strategy. It's genuinely a life strategy. It teaches you to consistently look for substance over flashy style, to think for yourself instead of blindly following the herd, and to deeply understand that the greatest rewards in life often don't come from frantic activity and constant motion, but from patient, deliberate, well-thought-out action. So how can you actually start applying these ideas today, even if you don't have a lot of money to invest yet? Here are 3 simple, concrete actions you can take right now. First, become a business observer. Stop thinking about stocks as these abstract things bouncing around on a screen. Start thinking about actual businesses. Pick 5 companies that make products you know and genuinely love. Maybe it's Apple, Nike, Starbucks, or Netflix, whatever resonates with you. Your mission isn't to buy their stock yet. It's simply to understand them better. Go to a free site like Yahoo Finance and just look up 2 basic numbers for each company, the P/E ratio and the price-to-book ratio. You don't need to do anything fancy with this information yet. Just get comfortable with the language. Start training yourself to see the world through the eyes of a value investor. Second, start building a when, not if savings habit. The absolute foundation of investing is having money to invest in the first place. You can't put money to work if you don't have any saved up. Make a real commitment to yourself to save a small but consistent amount from every single dollar you earn, whether that's from a part-time job, an allowance, birthday money, whatever. Even if it's just $5 a week to start, the specific amount honestly matters less than building the habit itself. Automate it if you possibly can. This discipline is the absolute prerequisite for developing the patience you'll eventually need as an investor. And third, just read. Read voraciously. Browne's book is called The Little Book of Value Investing for a reason. It's accessible, relatively short, and absolutely packed with wisdom. But don't stop there. Read about Benjamin Graham and his groundbreaking ideas. Read Warren Buffett's annual letters to his Berkshire Hathaway shareholders, which are completely free online and widely considered masterclasses in both business and investing. Surround yourself with the thinking of these masters. Let their long-term perspectives slowly soak into your own thinking. It'll become your greatest defense against the constant short-term noise and panic of the world around you. That was a summary of The Little Book of Value Investing by Christopher H. Browne. We've touched on the major landmarks of this incredible philosophy today, but I'll be totally honest with you. Reading a summary is kind of like looking at a map of the Grand Canyon. The real magic, the truly transformative experience, happens when you actually go there yourself and see it with your own eyes. It's in those quiet moments when a particular story, or even just a simple phrase from the actual book, connects with you in a way you didn't expect, in a way that genuinely changes how you see things. This summary is designed to help you decide if this journey is worth your personal time and attention. If anything we've explored together today has sparked even a little bit of curiosity in you, I truly encourage you to grab a copy of the book itself. Reading it isn't just passive learning. It's an active experience that can genuinely reshape the way you think about money, business, and your entire financial future. The link to grab the book is sitting right there in the description below. Also, if you found this journey valuable and got something useful out of it, please take just a moment to hit that subscribe button and give this video a like. It honestly tells us we're on the right track with this content, and make sure you won't miss our next deep dive into another potentially life-changing book from the Billionaire's Bookshelf. Let's keep learning and growing together on this journey.